The first scalping strategy takes less than 30 seconds to spot on the chart, but most traders completely ignore it. You open your 15-minute chart, you spot a single candle, and you draw its high and low. This creates a range. Now you simply wait and watch what happens next. If the next candle breaks the range and then closes back inside it, that's a liquidity sweep, and that becomes your signal. Now switch to the 1-minute chart. You'll notice the same thing. The high and low of that 15-minute candle now form a range on the lower time frame. Price breaks below the range and then closes back inside it, forming a liquidity sweep. That's your entry. You enter at the close of the candle that moves back inside the range. Your stop loss goes below the range, and your target is the next key level. Look at what happened. The market moved straight to the target. Now let's look at another real chart example. Again, start with a single candle. Draw its high and low to form the range. The next candle breaks above the range, but then closes back inside it. Now switch to the 1-minute chart. Observe what happens. Price breaks the range, then closes back inside it, creating another liquidity sweep. You enter at the close of the candle that moves back inside the range. Your stop loss goes above the candle, and your target is the next high. Look at the result. The market reaches the target as expected. This strategy is not a holy grail. Always use proper risk management and trade it in the direction of the trend as explained in my previous videos on the channel. Now let's move on to the next strategy. Look at this chart. You've identified a clear support level where price has bounced twice. It's a key level that catches everyone's attention. Now look at what happens next. Price approaches that level again. You expect another bounce, so you place your trade. But instead of bouncing, the market drops just enough to hit your stop loss, and then immediately reverses. Annoying? Yes. But here's the reality. Institutions do this on purpose. They hunt stop loss orders, collect liquidity, and then push the market in the direction they really want. Now let me show you, in 30 seconds, how to trade the stop loss hunt strategy. You identify a key support level. Price hits the level and reverses. It pulls back, comes back again, and reverses again, so the level is clearly respected. Now price approaches the level one more time. A rejection candle appears at the level. At this point, you do nothing. You simply wait and observe what institutions are doing. Look at what happens next. Price suddenly breaks below the level and then closes back above it. That's a clear stop loss hunt. Now you enter at the close of the candle that hunted the stop losses. Your stop loss goes below the candle, and your target is the next key level. Look at the result. The market moves up exactly as expected. Now let's look at a bearish example. Price hits this level and reverses. It hits it again and reverses again. That forms a clear resistance level. Now price approaches the level once more. A bearish candle appears, and retail traders start selling. But look at what happens next. Another candle forms. It suddenly breaks above the resistance level, but then price closes back below it. That's a stop loss hunt. You enter at the close of that candle. Place your stop loss above the stop hunt candle, and your target is the next level. And look at the result. The market moves straight to the target. Now you may feel smarter, but remember, the market is often smarter than you, because sometimes there is a stop hunt of the stop hunt traders. Here's what that means. You spot a stop loss hunt at a support level. You feel confident, you place your entry, your stop loss, and your target. You're ready to make money, but look at what happens. The market hunts your stop loss and then moves to the original target. That's what I call the stop loss hunt of stop loss hunters, because the market is always one step ahead. So what should you do? You stay calm and you re-enter. Look at this example. You spot a stop hunt at a resistance level. You enter the trade, but another candle forms and hunts your stop loss. You don't get emotional. You don't get angry. You simply re-enter with the new candle. And look at what happens next. The market moves straight to the target. The stop hunt of stop loss hunters doesn't happen every time, but when it does, now you know exactly what to do. Now let's move to the next scalping strategy. Look at this 15-minute chart. You can see the market forming one strong bearish candle, followed by another one. At this moment, the market is not just moving down, it's entering a state of fear. Traders who bought earlier are panicking, stops are getting hit, and emotions start to take control. Now switch to the 1-minute chart. Here, you don't enter immediately. You wait for a signal that shows resistance to that fear. And that signal is a bullish pin bar. Look at this candle. It forms right in the middle of that panic. It's like a small pocket of strength inside a fearful market. But you don't trade the pin bar itself. You wait for something more powerful. You wait for the failure of the pin bar. Look at what happens next. The market breaks through the pin bar. Fear takes over again. The small resistance disappears, and that's your entry. You enter at the close of the candle that breaks below the failed pin bar, a stop loss above the failed pin bar. Ride the momentum and scalp a few quick pips while fear is still controlling the crowd. Now look at another example. This time, the market is trending up. It forms one strong bullish candle, followed by another. Here, the market is in a state of greed. Traders are chasing the move. Everyone wants to buy before the price goes higher. Now switch to the 1-minute chart. Again, you don't enter immediately. You wait for a signal that shows resistance to that greed. And that signal is a bearish pin bar. Look at this candle. It forms against the bullish pressure. It's like a small wave pushing back against the crowd's excitement. But once again, you don't trade the pin bar itself. You wait for its failure. Once the failed pin bar gets broken, you enter right at the close of the candle that made the breakout. Place your stop loss below the failed pin bar and scalp a few quick pips while the crowd is still trapped in its emotional state. And look at what happens. The market breaks the pin bar, greed takes control again, and buyers step back in with force. This strategy is rarely talked about. It focuses on the emotions of the market, fear and greed. And understanding those emotions can give you a powerful edge. So if you're enjoying these hidden setups, support the channel with a like and subscribe for more strategies like this. Now let's move to the next scalping strategy. This one is based on a very simple tool, the 9-period exponential moving average. But here's the important part. Most traders use moving averages as signals. They wait for crossovers, confirmations, and multiple indicators, and by the time they enter, the move is already over. The 9 exponential moving average is different. It's not just an indicator, it acts like a dynamic line of control between buyers and sellers. When price is above it, buyers are in control. When price is below it, sellers are in control. And scalpers use that shift in control to take quick trades. Let's look at a real example. You open a lower time frame chart, like the 1 minute. Now look at where price is relative to the 9 exponential moving average. If price is trading above the 9 exponential moving average, and candles keep closing above it, that tells you buyers are in control. At this point, you don't chase the move. You simply wait for a small pullback toward the 9 exponential moving average. Once the pullback happens and gets rejected, that's your signal to enter the trade. You join the trend at that moment. Your stop loss goes below the candle that formed the pullback, and as long as price stays above the 9 exponential moving average, you remain in the trade. But once price breaks below the 9 exponential moving average, that becomes your exit signal. Now look at this chart example. Here, the price starts trading below the 9-period exponential moving average. At this point, you simply wait for a pullback. Look at what happens next. Price pulls back, reaches the 9-period exponential moving average, and then gets rejected, forming a clean bearish pin bar. That's your signal. You place your entry at the close of the pin bar with a stop loss above it, and you follow the short move. Now look at what happens next. The market continues moving down, and you keep riding the move. But here, once the market closes above the 9-period exponential moving average, you exit the trade because it signals a potential reversal. So that's the strategy. Simple and effective. Now let's move to the next strategy, the supply and demand scalping strategy. Look at this chart. You can see the market making a strong move up with large bullish candles and almost no pullback. This kind of move usually comes from institutions. Retail traders don't create moves like this, and the beginning of that strong move is called a demand zone. This is the area where institutional buying started. Now watch what happens next. Price eventually retraces back to that zone, and as soon as it touches the area, the market gets rejected. Buyers step in again, and price moves up strongly for a second time. Now look at another example. Here, the market makes a strong move down with large bearish candles. This type of move is also driven by institutions, and the beginning of that drop is called a supply zone. Now watch what happens when price returns to that area. As soon as price reaches the zone, it gets rejected and drops strongly again. Why does this happen? Because these are institutional zones, areas where large orders were placed before and where unfilled orders may still be waiting. But not every zone is strong. So how do you know if a zone is truly institutional? There are 4 simple criteria. A strong, impulsive move away from the zone. Large candles with little or no wicks. The zone is fresh and not tested multiple times. A clear break of market structure after the zone. A good risk to reward ratio. When these conditions are present, the zone is more likely to be institutional. Look at this 1-minute New Zealand dollar to US dollar chart example. As you can see, price forms a strong bullish move. The beginning of that move creates a demand zone. Now let's check if this is a high-quality demand zone. The move is strong, the candles are large, the zone is fresh, there is a clear break of market structure, and the risk-to-reward ratio is attractive. Now look at what happens next. As you can see, once price retraces back to the zone, it gets rejected, forming a clean pin bar. So here, you place your entry at the close of the pin bar with a stop loss below the zone and the target at the next level. Look at what happens next. The market reaches the target as expected. Now look at a bearish example. Here, the market forms a strong move down, creating a supply zone. Price retraces back into the zone and gets rejected. That's your entry. Stop loss above the zone, target at the next level below. And once again, the market moves in your direction. But remember, this strategy is not a holy grail. You need to use top-down analysis, trade with the higher time frame trend, and apply proper risk management to stay profitable in the long run. Now let's move to the next strategy, the bait and switch session scalping strategy. This setup is based on one simple idea. The market often makes a fake move during one session, and the real move during the next. But this strategy only works during 2 sessions, the London session and the New York session. So first, we need to mark those sessions on the chart. Here's how to do it. Open TradingView. Click on Indicators. In the search bar, type Sessions. Select the indicator called Sessions created by JRFX Addict. Now go to the indicator settings. Uncheck the Asian session. Set the London session opacity to 50. Set the New York session opacity to 50. That's it. Now your chart is clean. London is marked in green, New York is marked in red. Now let's look at how the strategy works. During the London session, you identify the most recent key level. In this example, this resistance level is the most recent one. That becomes your reference. Then you wait. During the New York session, price returns to that level. Look at what happens. Price reaches the level, breaks above it, and then closes back below. That's the bait and switch. The breakout attracts buyers, but the close back below shows rejection. That's your signal. You enter at the close of the sweep candle, place your stop loss above the level, and target the next key level. And as you can see, the market moves directly to the target. Now look at the second example. This level was also formed during the London session. During New York, price approaches the level, breaks above it, and closes back below. At first glance, this looks like a perfect setup. You enter the trade, place your stop loss, and wait for the move. But this time, the market goes against you. Why? Because you ignored one critical rule: higher time frame alignment. If you trade on the 5-minute chart, you must check the 30-minute chart. And in this example, the higher time frame was bullish, so the short setup was against the larger move. This trade should have been ignored. Now look at the final example. Here, the level was formed during the London session. During New York, price breaks below the support and then closes back above it. That's the bait and switch. But this time, we check the higher time frame. On the 30-minute chart, the market is trending up, so everything is aligned. Now we go back to the 5-minute chart and execute the trade. Entry at the close of the sweep candle. Stop loss below the level. Target at the next resistance. And as expected, the market moves directly to the target. This strategy is powerful because it focuses on timing, session behavior, and higher time frame alignment. But remember, this is not a holy grail. Always trade with proper risk management and in the direction of the higher time frame. Now let's move to the next scalping strategy, the break and retest setup. Look at this 5-minute chart. The market is clearly trending up. Here, price makes an impulsive move higher and breaks above this resistance level. Then price pulls back. And once it returns to the level that was broken, look at what happens. The level now acts as support. Price gets rejected, and moves up again. Why? Because this is how an uptrend works. First, you get an impulsive move where buyers push the price higher. Then those buyers start taking profits, price retraces, creating a pullback. But that pullback usually returns to the previous resistance level that was just broken, and once price reaches that level, it is now seen as a good price to buy. So buyers step in again, and a new impulsive move forms. So how do you trade this? Look at this example on the 5-minute chart. Price breaks above resistance, then pulls back to the level. As soon as price rejects the level, that's your entry. You place your entry at the rejection candle, your stop loss below the level, and your target at the next resistance. And as you can see, the market moves up as expected. Now let's look at a bearish example. Here, the market is in a downtrend. Price makes an impulsive move down and breaks below a support level. Then price retraces back to that level, but this time, the old support becomes resistance. Once price reaches the level, it gets rejected and drops again. That's your entry. You enter at the rejection, place your stop loss above the level, and target the next support. And once again, the market moves in your direction. This strategy is simple. Wait for the break, then wait for the retest, and only enter after the rejection. Now let's move to the next scalping strategy, the fair value gap setup. Look at this illustration. You can see the market making a strong, aggressive move in one direction. Large candles, almost no pullback. When price moves like this, it doesn't trade every level smoothly. It moves so fast that some price areas are skipped, and that creates what we call a fair value gap. This gap represents an imbalance between buyers and sellers, an area where the market moved too fast without proper trading activity. Because of that imbalance, price often comes back later to revisit that area, not randomly, but as part of the market's natural rebalance. Now let's see how to identify it. A fair value gap is based on a 3-candle pattern. You look at the first candle, the second candle, which is large and impulsive, and the third candle. If the high of the first candle does not overlap with the low of the third candle, the space between them is the fair value gap. That area becomes your zone. The same logic applies in the opposite direction for bearish setups. Now let's see how to trade it. Look at this example. The market makes a strong bullish move, creating a fair value gap in the process. Later, price retraces back into that gap. And look at what happens. As soon as price enters the zone, it finds support and moves up again. That's your signal. You place your entry at the rejection inside the gap, your stop loss below the zone, and your target at the next resistance. And the market moves up as expected. Now look at a bearish example. Here the market drops aggressively, creating a bearish fair value gap. Later, price retraces back into that area, and as soon as it reaches the gap, it gets rejected and moves down again. That's your entry, stop loss above the gap, target at the next support level. And once again, the market moves in your direction. And that was the final scalping strategy. Now you've seen the complete framework. The key is not to use all of them, but to master one or two and apply them with discipline. If this video gave you value, make sure to like the video, subscribe to the channel, and hit the notification bell so you never miss a new strategy. Thank you for watching, and I'll see you in the next video.